Welcome to Multiple Perspectives. I'm David Lofgren. This episode is a special one, not only because I'm joined by EquityMultiple co-founder and CEO Charles Clinton, but also because EquityMultiple has just passed an important milestone. We recently celebrated 5 years since our first investment offering. It seems only appropriate that, to mark the occasion, we hear the story of how EquityMultiple came into being. I'm excited to learn more about how Charles and his co-founder, Marius Schulson, started the business, how he's had to adapt to changing conditions, and what he sees as the future for EquityMultiple. Charles Clinton, welcome to the podcast.
Thanks for having me. Excited to do this.
I'd like to start by establishing a bit of your biography. Can you tell me briefly about your family, who you were as a child, where you grew up?
Sure. I grew up in New York City. My parents split up when I was a little kid, so I was mostly raised by my mom in the very northern tip of Manhattan, a neighborhood called Inwood that even those familiar with Manhattan tend not to know. Lived here my whole life until going to college, and I went to Amherst in Massachusetts for undergrad, and then I spent a few years after college, I guess generously called finding myself. My mom might have called it just being a vagabond. I basically worked a few odds and ends sort of jobs, save some money, then I would go, backpack for 3 or 4 months until my money ran out. Then I'd come back and, live someplace different and earn some money and go do the same thing again. Lived in New York for a little while, in Seattle, and ultimately ended up in the Bay Area. After a few years of doing that, realized that my long-term job prospects weren't too good and ended up studying for the LSAT and deciding to do law school. Relocated to Berkeley for law school in 2008, and so I got to spend 3 years out in that beautiful part of the world and, heard the siren call of New York when I graduated and came back for work.
So after law school, you get a job working at Simpson, Thacher & Bartlett. And now this is like a very large international law firm, right? They're over 100 years old. They have giant clients. You end up working with some pretty significant clients. You're working for KKR and Blackstone, like huge private equity firms. Can you just explain what that experience was like?
Yeah, I think, like I said, I think I was still pretty naive even coming out of law school as to what this world really was. And what I knew is if I was going to really do this, I wanted to try to work, in the best possible place and get the best experience with the biggest companies. And for the type of work I wanted to do, really focusing on kind of business transactions and ultimately real estate work, but for my money, there's no better firm than Simpson. Like you mentioned, Blackstone, that was really the client I did the most work for. And, whether it's on the real estate side where my focus was, but now, spanning a bunch of different aspects of private equity, they're doing the largest transactions, the most visible, the most complicated, the most interesting. The flip side of that is that everything has to happen yesterday. There's times that I would lose 2 months of my life. It would be stay into the office until 3 or 4 in the morning and come back at 7 or 8 in the morning because you had something closing and it had to get done. So definitely a challenging, way to spend some years, but it's also, really good trial by fire. You learn quickly. All your colleagues are incredibly bright and incredibly motivated. So even though I decided it, wasn't for me, definitely a great experience. At least in some ways, not the working until 4 in the morning.
It does sound like good training for founding a startup.
Absolutely. It's all in.
So how do you get from there to deciding you're going to go out on your own, you're going to delve into this new emerging sector? Like, I think something I'm always fascinated by is what it takes for someone to found a new company. You are taking a big leap of faith, even if you have a real good hunch. So yeah, how'd you get there?
Yeah, look, I think there's definitely a combination of being, having a little hubris and being a little naive that goes into founding a startup. I knew, I won't say going into it, but I went to law school because I wanted to step foot into the professional world. This is a good time to learn quickly, get good experience, get credentials, and get into the game. And, I think, at the job at Simpson similarly to that, as maybe this is where I end up, but maybe this is just a stepping stone to something else. And one of the things I think attracted me to the world of startups was the uncertainty of it. That's something that just is who I am a little bit. The fact that what your job is on day one of a startup versus what my job is, 5 years in is totally different. I love that. And then the other side of it, of course, is just seeing the particular opportunity, right? So the rise of our whole industry was really because of the Jobs Act. Essentially, the Jobs Act made it easier to market investments in what I would call modern ways, essentially to use the internet to market. That's the way it's played out. And there were a few companies that started doing this right after the Jobs Act was passed in 2013. I followed that really closely. And from where I sat, being a lawyer, being in real estate, it just seemed like there was a real opportunity opening up here because there was this really big regulatory change that was going to change how money flowed. And, to me, seeing some of the holes on the real estate side of the business, it felt like there was a huge market opportunity. And, the combination of wanting to pursue something a little bit more, aggressive, and seeing this chance to step into a new sector made me take the plunge.
Can you take us back to that time period? Was this big news in the real estate sector, in the finance sector, or was this just sort of one small piece of a larger piece of legislation that only sort of slowly unfolded?
I would say more the latter. Certainly for the slice of the real estate and finance world I was working in, it was not big news. This really doesn't impact giant transactions, at least not at this stage. It's more about creating ways for investors to get into medium-sized transactions, things where the capital markets aren't as defined. And I think, of course, for like lawyers, it's kind of a nerdy lawyer story. So I was probably more likely to stumble across it. The intent of the Jobs Act really was totally unrelated to our business and to real estate. The intent really was to help startups and businesses get funding more easily. I think that real estate became a really natural application really quickly because for individual investors, it makes a lot of sense to enter into real estate as your sort of entry point into real estate, into alternatives rather than venture, just given, the kind of risk return profile. Venture tends to be very zero sum, something either doesn't work or it works really well, while real estate, has much more stability. It's cash flow oriented, has appreciation, not something where people are going to get rich on a single investment, but where you can kind of incrementally build wealth over time. And it's really historically been, the entry point for a lot of individual investors. So while not the intent of Congress when they passed this, I think the companies that sprang up initially and then ultimately have grown to be successful, a big portion of it have been real estate because of that fit.
Right. So take me through that sort of early phase of you're aware of these changes happening. So at what point do you decide that you're going to leave your day job and try and make your way in this space?
So I'd say it was about a year after, the first companies started showing up. So, the Jobs Act was 2013. It actually went into effect. It was passed, I believe, in 2012. I left in end of 2014 to start EquityMultiple in the beginning of 2015. And, I think I looked at what the other companies were doing, felt like I had enough of a thesis about what they weren't doing that I still saw there was an opportunity that wasn't being covered. And I guess on a personal level, where I really saw this gap was, despite working for Blackstone basically on a daily basis, if I wanted to invest in commercial real estate, what I was doing was going into Brooklyn on the weekends with my friends and touring beat up old brownstones to see if there was one we could put our money together with to buy and rehabilitate and sell.
Sure.
And that just seemed so nutty to me. And, I just didn't really, couldn't be my job, didn't have the time to do it. Certainly for the amount of money I was investing, it didn't make sense to be spending all of that time. So I think I really felt firsthand that there was that gap in opportunity for investors.
So tell me about that. What happened? At some point, you and Marius Schulzen, your co-founder, tell me how you guys linked up and when you actually fill out the paperwork.
We got connected through mutual friends in real estate. I think I knew that I don't have all the skills needed to start this business, not by a long shot. So I was a little bit on the hunt for a partner, trying to find someone on the other side of private equity that had this whole other piece of the coin that I didn't have any experience with. So, we got along really well personally, and I think he very much agreed with the opportunity. And from a skills perspective, we've always, matched up with each other really well.
Right. Yeah. It's interesting how, particularly because you're essentially establishing a business in a void, right? In a brand new sector, that no one person could possibly have the skill set to start the business themselves. And it's incredibly complicated. I mean, you're merging finance and regulatory law and real estate, and then layering technology on top of that. Can you talk about that? Once you've identified Marius as a suitable partner, what you do to try and get this business off the ground? I imagine you have to raise some capital, and you and Marius made a really interesting choice that sort of differentiates you from the rest of the marketplace in the way you did that. And then soon thereafter probably started to have to build your team of specialists, right? So walk me through those steps.
Yeah, it's all of this stuff involves some planning and some luck. So, I think we, of course, put together a business plan. We really flushed out what we wanted to do as version one of this business. And in talking about our options for funding, I think we talked about one, either looking at sort of traditional seed investment kind of funds. And then on the other side, talking to people within the real estate industry where we might be able to get some strategic value out of their investment other than just dollars. And where we landed on was that the latter, if we could find it, was our preference. Given the complexity, we felt like we had to not solve, but at least get a leg up on one side of the business or the other right when we were getting started. So, of course, we need to find both investors and we need to find deals. And then we need to figure out how to connect them through a technology platform. So we were hoping that we could solve at least the deal portion of this in the early goings. We looked for real estate companies that might have an interest. And, we had a couple preliminary conversations. And where we landed was that a brokerage firm, some kind of capital markets firm would be the best partner, because ultimately they're going to have the broadest access to real estate sponsors compared to a individual real estate operator who would be able to offer us their deals, but not offer us to, the broad range of deals that we wanted to present to investors. And, honestly, we probably had 3 formal conversations on funding, maybe even 2.5. And, we had one with Mission Capital. They'd been thinking about building a similar business themselves for a lot of the same reasons. They knew they had access to the right type of deal flow, and they'd even started building a technology product. They were very technology focused kind of capital markets firm. We're really ahead of the curve on some of that. So they started down the road and then ultimately decided, hey, we have these 3 business lines that are already generating a lot of revenue. We don't know if we can really push forward with this. The idea of providing some money, some strategic guidance was a really good fit for them too.
Okay, so you've got some initial funding, you've got your partner, and now all you have to do is build an elegant and seamless technology solution, right?
No problem.
Yeah, what's the next step here?
the fact that Mission Capital had already started building something meant that they already had someone working on it. So their CTO, Peter Shanker, really became kind of part of the deal. And luckily, we all liked each other. Between us, Peter, and the guys at Mission who invested, we kind of came to a solution of, all right, let's transition Peter from being CTO with Mission to being CTO with EquityMultiple, really take this idea on the technology side that had been worked on, but was still in its infancy, and figure out how to, grow this into a product as we build a business around it.
So as all of these pieces are coming together, are you the CEO officially at this point? Like, do you guys have your titles as you go in as founders?
Yes, we didn't day one, but we had the conversation early. I think it's not to say we didn't make a whole host of mistakes in the first year, but we did not make the mistake of, punting who's doing what, which I think a lot of startup founders do, like, oh, we're all in charge. We all are co-CEOs or whatever. We said, all right, you're good at this, you're good at you're good at this, and hey, you're the guy who's not good at anything, Charles, so you get to be CEO.
So is there a moment or like a series of events in the first couple years that felt like big wins or something that told you that you were on the right track?
So, the analogy I would make, and this is probably related to me having a 2-year-old and another soon on the way. The analogy I would make is when you have a really little baby, there's these constant false summits. So, when a baby's 6 weeks old and they sleep for 2 nights in a row, you think to yourself like, oh, I've done it. This baby's sleep trained, no problem. I'm on the other side. And then 2 nights later, it's, up 6 times in a night. And the early days of a startup are a lot like that. You are looking everywhere for a sign that what you're doing is working, right? For product market fit, right, is the buzzword you'll see absolutely everywhere if you do any, startup reading.
Right.
And there's a lot, because you're looking so hard, there's a lot of false hope with that. I'll tell you, we thought it was working when we did our first investment, which was $500,000, and it took us 4 months to fund. And that is a good first hour of an investment now. Your perspective on what constitutes progress really, really evolves over time. I would say that when, in retrospect, look at that moment of real evolution was when we started moving out of equity, not fully, but we started experimenting outside of equity investments and doing preferred equity investments. That decision was really driven by what we were seeing in the market, the investments market. So we knew immediately that our customers agreed. They saw the value in this kind of product at this point in the market cycle, because the speed that things started to fund on our platform dramatically accelerated. The average size of our raise on a per investment basis, multiplied by, an order of magnitude within a year. We really knew that things were operating differently at that point.
Right. Yeah. It feels like 2018 is the year that is a bit of a tipping point in the early trajectory of the business. I guess the fall of 2018 is when you essentially doubled the size of the EquityMultiple team, right? So it's like when you brought on CFO Brett Klein, Henry Kwong came on as Senior Director of Asset Management. Like, how did that change the business? I'm interested in how adding a bunch of people to the team changes the business, like from an operational perspective, but also from a company culture perspective.
Yeah, it was a really dramatic transformation. Over the course of 6 months, I think tripled the size of the team, maybe more.
Wow.
We received a round of funding in summer of 2018, and we immediately, set to work with hiring people. And, I think the biggest difference is, everything's really in your head. If you only have a handful of people working in a startup, your discipline does not have to be as strong as it does as you grow as an organization, because people are wearing multiple hats and there's so much institutional knowledge in everyone's head that you're not documenting everything the way that you do when you need to pass off work from one person or the other. And there's a totally different build from an organizational perspective, once people start to get more specialized, and especially as you bring new people on who don't have any familiarity with what's happened in the past. So, it was definitely transformative for us, both in terms of the business result, of course, how much investment flowed into through the platform in 2019 versus 18 was dramatically different. But also, what was happening underneath the hood. Every one of our processes has improved. Some of them that our customers see and some of them that our customers will never see, but are, of course, designed to kind of bolster the ultimate results, of the investments, but also reporting. I think towards the idea you mentioned earlier that, you have all of these different roles for this kind of business. We were able to really augment the business with new specialists. So incredibly transformative. What we do today internally is night and day from where we were in 2018.
Right. Yeah. What does it feel like as the CEO to go through that change? Like, how do you navigate becoming a leader of a growing organization? Like, I can only imagine it feels different calling yourself CEO when the team is 5 people than it does when it's 20 people.
Well, I would say it feels a little bit more credible. I have to say, for the first few years when we were a team of 5 people, and I told someone, a friend or someone at a dinner party, that I was a CEO, I always felt a little bit silly. I think there's a lot of CEOs of two-person businesses running around, and it's not really that job until there's a little bit more of an organization. And certainly that was my experience. My job was night and day different also, and definitely a little disorienting at first. A pretty different skill set, to be more focused on management and financial planning and team building than some of the daily doing that I was very, very in the weeds of for the first few years. So, a combination of hard, exciting, all of those kind of mixed emotions that come with getting thrown into a deeper pool.
Was it difficult to get out of the weeds? Like, I can only imagine when you're intimately involved in every offering that goes on the platform, it's got to be hard to say, okay, I think you got this.
Yeah, I mean, I'm sure there's people who will tell you that I'm not still fully out of them. And look, I think as much as I say that I was never sure I was going to be a lawyer forever, I certainly have some lawyer brain that I picked up along the way, or maybe always had, and I feel very comfortable getting into the weeds and being operationally minded and all that sort of stuff. So in a way, pulling out of that is pulling out of my comfort zone, and so definitely a challenge, but I know it's a healthy one for me, and think that we've been able to hire such great people that's made it easy. I think that delegating is about having confidence in your colleagues, and I certainly have a ton of confidence in our whole team.
Thus far, we haven't touched at all on the reality that we're all living through at this moment. We sort of know that the story of the growth of EquityMultiple and of the industry as a whole is eventually going to hit March of 2020. But before we get there, I'm hoping that you can paint a picture of what things were looking like through 2019, for you as the CEO of this growing business, and also just for the commercial real estate industry more broadly.
Yeah, I mean, I guess, working in reverse order there, I think that the industry was, continuing to put up kind of year over year growth. In some markets, there were signs that the price of assets were past peak. But for the most part, you were looking at transaction volume growing, prices growing. It was really in a pretty good place, though, we, and I think a lot of people had some doubts about the sustainability of that growth because eventually recessions happen. The pandemic is obviously the thing that lit the match, but I don't think we were going to just keep growing. And for Equity Multiple, we were in a bit of a different place, from a trajectory perspective. We did, about 135% growth between 2018 and 2019, both in terms of total investments originated through the platform and revenue. We felt like we were similarly situated for that level of growth in 2020. So, we had carved out a little bit of a niche by focusing on preferred equity, like I mentioned, and felt like we could continue to build that product, even as market conditions were maybe changing a little.
Right. So that brings us to the inevitable coronavirus pandemic. And, I had to go back to figure out exactly what the dates were. I was looking back through my emails. And it's interesting looking backwards, knowing what the future is going to hold. Equity Multiples was really quick to respond to the coronavirus. Internally, there was a social distancing action plan that I think went out on March 10th, a week before we were hearing that New York City was going to be locked down. Once that lockdown went into effect, mandatory work from home policy was implemented. I'm wondering if you can sort of look backwards a little bit, though, and talk about your thought process in the early days of the coronavirus outbreak. To put a fine point on it, like Equity Multiple's headquarters is in Manhattan. New York City was at the time the epicenter of the national outbreak. What kind of things were you considering in those early days?
I think that's very important preface to the whole thing. It's easy to say, hey, you locked down before other people did. You were ahead of the curve. But I will tell you, if you were on the ground in New York, it really felt like a very sudden cascade at that point in March. We knew we had to act decisively because, we would much rather be ahead and have taken too much precaution than be behind and put any of our employees at risk. So first and foremost was getting people home and safe. I think fortunately we knew that our business was one that we could operate pretty well remotely. It's not like we have a storefront. We do everything. Our storefront's the internet. We use a ton of digital communication. We work with people all over the country and the world. So, I think we were very lucky in that regard. It made that transition relatively easy. The things that I was looking at once we got through the real logistics of the early days was making sure that we were situated to endure whatever lay ahead. We went to our board, we went to our advisors and said, look, here's where we are, here's what we're thinking, here's what we're doing in terms of concrete action. But, the number one thing we need to solve is making sure that we have, enough balance sheet to sustain doing less business for a while, because it's just uncertain when business will normalize. So Ken, our largest single investor, stepped up immediately and said, I believe in what you guys are doing. This is temporary. I'm going to invest more into the business. Obviously that gave confidence to other investors coming in. And, we were really able to solidify the balance sheet of the business in a way that was important. And, across the business, we did the same things that I think every smart business did at that point, which was tighten down all your expenses, look everywhere for ways that you can save cost, prioritize keeping all of your team. But, we really feel like on that front, we went through pretty unscathed, and that put us in a position to, start ramping up our business again now as the economy has really returned, and we're starting to see really interesting opportunities for investment on a forward basis. Once we got through the hard part of kind of making sure that we were on solid footing, we started turning towards the opportunity set and, how can we maximize this for our customers? How can we maximize this for our company?
I do want to talk about there have been a lot of strategic decisions made moving through this time, and obviously, we're not through it yet. So I'm not going to try and ask you to do too much crystal ball peering, but I wonder if you could just walk through some of the strategic decisions that you made in order to position EquityMultiple, both for survival through this time, and also, if there's a way to see upside potential as we move through it.
Yeah, look, I obviously, it's important with this stuff to separate out your role as a human and your role as an investor. And the human element of it is that this is an incredible tragedy and it's horrific. But, from the perspective of running a business and, having customers who count on us for investment and helping them grow wealth and build retirement savings and put away money for their kids, we always saw that this was going to be a period of tremendous opportunity for, again, both our customers and us by extension. The fact is that recessions bring asset repricing. And I think we're kind of getting to that period right now where people who didn't want to sell because they were hoping they could get through it are now thinking, okay, well, my cash flow isn't good. I need to sell and get out while I can. And, those sort of situations create opportunities for new buyers and new investors to buy in at a lower price, make it through this period of recession and, hold through to the new period of growth. We've kind of internally mapped out these different stages where we feel like there's going to be opportunity evolving over the next year. And we plan to really curate the types of investments that we're offering based on these evolving market conditions.
Yeah, it strikes me that, as a business that is both looking for investment opportunities to surface for our investors, and also as a business that has been curating investment opportunities over the past 5 years, we've sort of got vested interest in both sides of this. I think the saying that has been going around quite a bit is the quote that's attributed to Warren Buffett about, only when the tide goes out do you discover who's been swimming naked. Do you feel like the pandemic has revealed things about our historic investing philosophy? How do you feel, now that the tide has gone out, about the choices that have been made?
Yeah, that's a great question. I think that as much as there's opportunity on new investments, we of course have to deal with the ones that were made at in different conditions. Incredibly happy that we hired Henry Kwong a couple years ago. I will definitely say that, and all of the progress him and his team have made in terms of maturing the asset management side of our business has made a world of difference. I think that our transition into focusing on preferred equity in 2018 also has made a world of difference for investments in the most challenged areas, hotels, retail, areas where we have very little exposure, honestly, particularly retail. There needed to be very active management, and the asset management team was able to work with the sponsors, try to get good outcomes. If an investment needed to be worked out, they were able to get that process up and running quickly. It was very much an all hands on deck, both for the people who are in the asset management team full time and also, people on the investment side pitched in and helped and, made sure we could maximize outcomes in any way.
What have you been doing over the last 9 months that helps you feel, hopeful or emotionally buoyant?
That's a fair question. I think that is a challenge. I think the challenge to just about everyone right now, at least in parts of the country where there's restrictions in place, which is just about everywhere at this point. To me, I think there's two things that have really, really helped get me through what's been a challenging time, on a personal level. One, honestly, is work. As hard as the first few months were, the months since have been an exciting challenge and, focusing on where the opportunity is, focusing on what we can improve. We're really focused on providing the right type of investments at this particular moment. So that's opened up a window to look at other aspects of our business and see how we can improve. And I love that kind of work. So that's definitely been a piece of it for me. And the other is, just having more time with my family. Honestly, I know everyone's a little bit too on top of each other these days, and work from home is not all it's cracked up to be. I think that's maybe a national learning at this point. But I have a young daughter, and my wife's expecting again in the beginning of February, and to spend all this time with them, I'll always look back at that fondly, despite all of the challenges of this time.
That's great. I wonder where you see EquityMultiple headed. Maybe let's first talk about like a year from now. Where would you like the business to be?
I think we feel that our model is a strong one, that our focus in providing good structured investments, being involved from, the point of investment all the way through to the point of, sale or maturity is the right competitive model for us. So, a lot of what we want to do over the next 12 months is scale what we're already doing. So we're hiring again right now. We are picking our opportunity set. Like I said, we're trying to map out where we see the best investment options over the next 12 months. That will change, as market conditions change. But, we feel like this is going to be a time to go from being unusually low volume to being much higher volume in 2021.
I said at the top that we just passed the 5-year mark of the first offering going up on the platform. And clearly, we've established throughout the course of the interview that a lot has changed. A lot of things have shifted, some foreseen, some not so much. But I wonder if you have a sense of where we could be in another 5 years.
Yeah, it's definitely something I ponder. Ultimately, I see this whole market maturing a huge amount over this time span. I fundamentally think that we're still in the second or third inning of this industry. As much growth as we and the industry as a whole has experienced over the last 2 or 3 years, my sense is that we haven't crossed over into the kind of mainstream customer adoption period yet. I think we're not just with the early adopters. The kind of profile of our customer is much broader than it was a couple years ago. But we're still talking about all of us and all the businesses like us. We have hundreds of thousands of customers between us. But I think that this is a industry that will see tens of millions of customers in 5 years. So, like I said, scale is a huge part of it, and I think the nature of the business will change with all that scale. Certainly, our thinking is that a lot more automation, more options for investors to concentrate more on building their portfolio than picking individual investments. Giving investors that option of how they want to diversify outside of stocks and bonds. While we are solely focused on real estate right now, I think that in 5 years, platforms like ours will be more diversified. Ultimately, our customers want alternative investments. Real estate, for most institutional investors, is the biggest component of that, but there's companies like us that do venture capital, and there's companies like us that do, more niche things than that. And I do think that from the consumer's perspective, having that all housed under one roof so that they can have one place where they do their stocks and bonds and one place where they manage their alternative portfolio makes a lot of sense for them. And ultimately, if it makes sense for the customer, it makes sense for the industry. So, I think we'll get there. We have been very focused, as I said, on being in real estate because I think it's important to grow expertise and get economies of scale and not trying to bite off more than you can chew, especially in the world of investments. But whether it's through merger or acquisition or hiring a team, I do see us expanding verticals, in that kind of more long-term time frame.
Yeah, it's a pretty exciting time to be both an individual investor that's interested in alternatives, and also a business that's working in the space. It seems like there's a lot on the horizon. Charles, thank you so much for doing this.
Oh, it was my pleasure.
That does it for this episode. Thanks again to EquityMultiple CEO Charles Clinton for being so generous with his time, and thanks to you for listening to Multiple Perspectives. Don't forget to subscribe to the show in your podcast app of choice, and you can rate and review us at Apple Podcasts. For more information and to see the offerings currently available on the EquityMultiple platform, we've got links in the show notes. For EquityMultiple, I'm David Lofgren. See you next time.